Hi and welcome to this week's Property Insider video. Our property markets are clearly on the move, so today Dr. Andrew Wilson and I discuss a number of news items that should be of interest to you. The auction clearance rates for the first big weekend of auctions so far, what's happened to house prices, what's happened to loan repayments, and an interesting statistic about the percentage of property investors that I've not heard before from Andrew Wilson. We'll also talk about inflation, what's going to happen to interest rates, and are we really going to fall off that cliff in March? So if you want to keep up to date with regular property insights, why not subscribe to our YouTube channel and click the little bell icon so YouTube can keep you informed each week when we bring out our new show. Property values rose to new highs in January, and they've got much further to go as home buyers and investors are entering our markets. They're encouraged by record low interest rates, by increasing consumer confidence, and news that our economy is picking up. Now, our on-the-ground team at Metropole is noticing a palpable change in sentiment. Home buyers and investors are already experiencing FOMO. They're being led by the media. They're starting to fear missing out a bit. Is this really going to happen? Well, they're reading about strong auction clearance rates, rising property prices, less stock on the market, and they're hearing that life is getting back to normal as the coronavirus vaccine is on the horizon. So there's been lots of news just in the last week alone, and that may give us some pointers of what's going to happen to our real estate market. So I'm really looking forward to discussing this news today with Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market. Hello, Andrew.
Yes, hello, Michael, and I guess I could say happy February to you. Can you believe it's February already? Where did January go? And we're certainly up and running big time in terms of our housing market energy. And well, by that I mean we're starting to get some data coming through now that's really, I guess, validating the expectations we had for this year.
Well, let's talk about the auction clearance rates, because last weekend was the first weekend where there was a substantial number of auctions,
Yeah.
and they didn't disappoint. Your chart that I've got up here on the screen at the moment shows very strong results for Melbourne, Sydney, in fact, everywhere.
It was a bit of a surprise, Michael, not so much the results, but really I would have thought that next weekend would have been the first weekend with significant numbers. Usually we just get a handful of numbers when we're in January for auction results, even if it is end of January. And I'm talking, maybe around about 100 auctions. It really did come as a rush and a big surprise, not only strong clearance rates about where we left off in December, and that's what we typically see. But we saw a surge in listings, very big numbers in both Sydney and Melbourne particularly, and Melbourne almost 3 times the number of auctions that compared to the same weekend a year ago. And that auction clearance rate in Melbourne, Michael, at 84% is actually the highest clearance rate for nearly 4 years for any weekend, and one of the highest ever recorded for the beginning of the season. So some very spectacular results, and not just from a small sample either, Michael. Those 300 odd auctions really quite significant for this time of the year. But of course, markets will be tested going forward with higher listing numbers, but gee whiz, it's a good time to be a seller in the Melbourne market at the moment. And I guess your problem would be, do we wait for high prices to go higher? Because these sort of numbers are real boom time numbers at the moment, particularly Sydney and Melbourne.
Well, our buyers agents teams, Andrew, are noticing a change in vendor sentiment and agent sentiment. People are not willing to sell before auction at the moment. People are not as interested in putting their properties on the market for private treaty. They're keen to go to auction, and these sort of results are only going to encourage higher number of auctions moving forward.
That's right, Michael, but we've got plenty of pent-up energy in terms of affordability in the Melbourne and Sydney market. This is no sort of out of control speculative market. We've been predicting this for months, that median house prices in Sydney and Melbourne are now back to their peaks after waiting since 2017 for that to happen. So really our prices are now back to where they were 3 years ago, Michael, 3 or nearly 4 years ago. So we've got plenty of capacity to push prices up. We've had lower interest rates and higher incomes through that period. So we've got a way to go before we get to an overreach in our markets. And of course, our strong and very prudential banking system and lending system means that we don't really overreach in terms of pushing prices up beyond what the limits for our LVRs and income requirements are.
Well, another leading indicator that we look at that's going to be another piece of the puzzle of what's ahead is home loans. And home loans surged not just owner-occupiers, but investors. But it
Yes.
came off a pretty low base, didn't it, Andrew?
Yeah, that's exactly right, Michael. And another correlating, I guess, evidence for strong housing market conditions. Another big number for home loan approvals over December. And closely looking at the data, it's quite interesting. Certainly, owner occupiers are still a driving force for that new home loan surge. We saw a nearly 10% increase over the month. Interesting when we do look at the numbers, even though investor lending increased from a low base, and I've got some data, Michael, that could be of interest. We actually have the record low proportion of investor lending compared to total home loan lending at the moment. So even though investor lending increased, everything else increased as well. And the proportion, the actual percentage of investor lending for compared to total lending for residential purposes is the lowest it's ever been, at just under 20% of lending. And conversely, the proportion of lending for first home buyers is near its highest level. Some interesting points there. It is a very low, even though it's increasing, and no surprise with higher prices attracting investors, and so they should. We will see lending for investors increase. The question is, will it increase as a proportion of the total market?
There's some great insights into those charts. The other thing, talking about lending, is every month APRA are now giving us an indication of what's happening to the deferred home loans. Those people who took a holiday, didn't pay back their mortgages for a period of time. And that's really dropped. 80% of all those loans that were deferred at the height of the coronavirus pandemic are now starting to be repaid. Speaking to some bankers, they were encouraging their clients to take these repayment holidays to actually build up their financial buffers in case things went wrong and things didn't go as badly as people expected. So as we say almost every time, there's no fiscal cliff to fall off.
No, there's not, Michael. And that, I guess, is going to be the next attention grabber in terms of our economy, and that will be the march into job seeker. And I think it'll go by hardly noticed at all. I still think the forecasts for unemployment are too negative this year. They're still talking about unemployment remaining in the sixes or high sixes for most of the year. I think we've certainly got a lot of downward pressure on the unemployment rate, employment growth at the moment, participation rates are back to very high levels. So things are looking good. And Victoria's still got a little bit of catch up to do as well. And we're seeing that come to the roar at the moment. So I think that a lot of the negativity around the economic environment is still there. I noticed that we sort of get those regular reports or measures of so-called experts predicting where the economy is going to go over the next 6 months. And I saw one of those today, and it was quite noticeable about all the word surprise in terms of what happened last year was peppered throughout the comments from these particular, perhaps a little left of centre economists and commentators regarding their economic forecast. And even they tend to be a little bit more negative than I thought that they would be. But look, we've bounced back quite reasonably, and our economy's doing well, given it's got some yards to go before we're back to where we were. But certainly our housing markets are in catch-up mode at the moment in Melbourne and Sydney. No surprise there. And we shouldn't break into a cold sweat about, an out of control, price bubble emerging. And we'll certainly get that word bubble sooner rather than later. You can bank that one, Michael. But this is just catching up Melbourne and Sydney to where they should have been without all those interruptions over the last 3 years.
The year also started with a bit of an inflation scare, Andrew, or at least the media trumped it up to be one as US and Australian headline inflation rose. And this led some media commentators to already speculate that interest rates are going to rise sooner rather than later, that the Reserve Bank's going to come in and try and tame inflation and put a lid on rising house prices. Andrew, they're the same columnists at it again, aren't they?
Well, yes, I know. And how desperate are you for a headline? That's the question I'm asking. I mean, the only basis for speculation for higher rates was that the actual result was, I think, 0.1% higher than the market expected, the market, whoever that is, their forecast. And it was just a little bit over market forecast. So does that mean interest rates are rising? Well, of course, that's complete nonsense. Inflation at the moment is adjusting to what was all those benefits, particularly for childcare costs, which has been a significant factor in the falling away of inflation during the shutdown period. Of course, those costs were subsidised by the government, and now that's coming back. Of course, we're returning, but there's some way to go before we get to a normalised inflation environment, and then we can speculate on the possible implications for interest rates. But gee whiz, Blind Freddie could tell you, Michael, that if we raised interest rates now, it would be the death of the economy, certainly. And in this nascent period for revival, we're just getting off the ground now. And the troglodytes are talking about higher interest rates with absolutely no rationale behind that particular outlook. We'll have interest rates around zero now for perhaps a couple of years. And even the Reserve Bank has said that's the case. We need to get incomes up. We need to get jobs up as well before we even think about higher rates. And it shouldn't be really inflation that's our main focus for our rate decisions. It should be factors such as incomes growth, because inflation follows incomes growth. And even government economists tend to put the cart before the horse in these types of discussions. But yes, it was interesting, I guess, but it was still January, Michael, so maybe a slow news day.
Well, there's lots of news to discuss today, as there will be, and we'll be back every week to have a bit of a chat with some insiders, some people who've been around the block a couple of times to give our perspective. Of course, not everyone agrees with what we say. You can see all those comments on YouTube, but that's okay. That's what creates a market, people having different opinions of which way we're.
I think opinions are fine, Michael, but if you can base them on evidence, that makes them a little bit more worthy of absorption, particularly if you're making investment decisions. It's important to have I guess, a conversation that's based on a rational approach to the market. And I think that's what we do all the time.
That's why I look forward to our chats. Look forward to catching up with you again next week.
Good on you, Michael. Thank you.